Welcome to this monthly update for February. I'm Julia Lee, an equity strategist at Bell Direct. Well, the V-shaped recovery continues for the Australian share market, the ASX 200 gaining just over 5% for the month. We've also seen markets around the globe doing well. The US stock market actually breaking back onto positive ground for the last 52 weeks. In terms of sectors, at the top is the tech sector, which has been the best performing, but right down the bottom is the consumer staples sector, which has been the worst performing for the month. And if you haven't had a look at the Chinese stock markets recently, now could be the time. The Shanghai Composite does look like it's put a bottom into place. In fact, the Shanghai Comp is already up 20% from the lows in January just this year. And of course, for investors that are interested in getting China exposure, it's easier than ever. The IZZ is an Australian domiciled iShares ETF, which tracks the FTSE China 50 index. Of course, the best and the worst in the month of February and August tend to be quite significant because this is where we get an idea of what trends are likely to continue over the next 6 months. In fact, looking back to August reporting season last year, and the top 5 gainers in the ASX 200 gained a massive 40% on average in the month of August. Since the end of August till now, they've gained another 10% on average, so have continued to gain as a group. On the flip side, the bottom 5% lost 24% in the month of August on average last year. A lot of people saw value in those stocks, but since then, that basket of stocks has lost another extra 14%. So if you're curious to know where the best and the worst performers are this half-year reporting season, on the best list is Revel Group, Appen, Altium, Ausdrill, as well as IOOF. The worst performers have been Bingo, Pact Group, Blackmore, Saracen, as well as Macmillan Shakespeare. One of the most interesting things to happen this month has been around interest rates here in Australia. We've seen the Reserve Bank moving to a neutral stance on interest rates, and Westpac's Bill Evans predicting 2 rate cuts just this year. UBS is predicting 2 rate cuts over the next 18 months. Of course, those type of predictions aren't good for the Aussie dollar, which has moved down 1.8% in February to date. Generally, though, that should be good news for the markets and supportive of growth. So the strategy at the moment, given the low Australian dollar, I'm preferring to be long Australian global leaders if you want exposure to the domestic market. Also long commodities, especially Australian miners, which should benefit from that lower Aussie dollar this year. Especially iron ore, given the dynamics in the market with supply coming offline due to that tailings disaster in Brazil, and energy also looking good. But still underweight some of those domestically focused sectors, including things like property as well as banks, as continued signs of stress in the housing market play out. So all in all, February reporting season has been a good one for investors. The Australian share market going up a gear in terms of performance and seeing a strong performance for the month of February, as had other global markets. I'm Julia Lee, an equity strategist from Bell Direct. Hope to see you next month.